So when we think about due diligence, why conduct due diligence, whether it's doing it yourself or hiring a third party provider, or leveraging a friend. It aims to protect your investment. You're risking significant capital, whether it's through a personal guarantee or a significant amount of private debt. Uh, there are serious risks when it comes to buying small businesses. It is known as the most risky asset class. While many of these businesses have been established and long lasting, it is risky. So conducting thorough due diligence protects your investment, and it ensures that you're thinking about the business in a different lens, and it avoids costly mistakes, things like getting the appropriate level of working capital, negotiating the proper terms, and then ultimately paying the a fair purchase price uh, for a business that can support the debt, whether it be SBA or private debt you take on, as you assume duties. So, what are the some of the smart buyer priorities? So, imagine you're under due diligence. It's just started. What are some of the key things you need to focus on in your short period of time? Typically, for those who have just joined the space, due diligence takes anywhere from 90 to 120 days. I've seen some have 30 and 60-day due diligence periods. The due diligence starts once there's a signed letter of intent. Um, any discussions before that is called, the preliminary LOI discussions. Once you have a signed contract, it shows in good faith that you as a buyer have serious interest to getting this deal closed. And more importantly, it gives you faith that the seller will in turn give you exclusivity period to conduct proper due diligence during that time frame. So imagine that this has started, and now what are the buyer priorities? The first question I always like to ask is you need to verify the revenue verification. Is the revenue real, recurring, and stable? How do we get there? Um, you can verify that the revenue is real through a thorough analysis of the company's financial statements in QuickBooks or another financial software. Um, you need to ensure the company is accounting for revenue appropriately in line with certain accounting standards. If you're not a CPA, hiring one is very beneficial. There can be certain accounting manipulations that are done to materially misstate revenue. In certain industries, such as construction and heavy project based, um, there is a complex accounting procedures called work in process and construction accounting, which can be easily manipulated if you don't have a trained eye. Um, from there, another buyer priority is expense analysis. Understanding what are the actual business expenses of the business, um, month to month, year over year, going forward. There may be certain expenses in the financial statements that are deemed owner operated. Think personal travel costs, the owner's salary, maybe discretionary bonuses the owner grants himself or herself during the 3 to 5 year financial assessment when you're looking at the business. I do want to caution expense analysis. When you do receive broker SIMs, more often than not, the brokers will try to include, they'll call them owner add backs, personal costs to increase the earnings of the business. More often than not, a lot of the expenses they deem as non-recurring or non-business like in reality are actually going to be incurred by you as a new business owner. I'll give you two examples. Um, Travel expenses, I often see as an add back. Um, A lot of the travel will be around the owner traveling for work-related conferences or uh, conducting sales meetings, which he has to use some travel. Some of his employees may travel for conferences, etc. The broker may present that these are, you know, non-core business expenses, but in reality, these costs need to be incurred going forward. So it's not appropriate to think that these costs are suddenly going to go away. Um, in reality, the only costs that are purely discretionary and you may be able to change or stop is owner salaries and owner discretionary, bonuses or salaries to some family members that won't be going forward. In reality, most of the expenses the business is incurring before transaction close will be incurred following, um, plus or minus, 10 to 15%. Just keep that in mind when you are looking at SIMs and you see a lot of heavy add backs. I would challenge these because um, you know, they may be actual business expenses. Um, Another priority is ensuring you understand the cash needs and cash flow of the business. I, I call it the cash flow truth. Ultimately, free cash flow is what is going to be paid to first the SBA bank or private bank to pay your monthly loan payments. Cash flow pays owner salaries, which will be you as the new operator. So understanding what is the actual free cash flow of the business is critical. Ways you can do that during due diligence is putting together a pro forma financial statement where you look at the free cash flow of the business and you layer in the debt costs, which are expected based on SBA amortization tables. And that'll show you if this business can actually support the debt you're looking to take on. The last piece is understanding what's in the balance sheet. What are you actually buying in the balance sheet, if anything? If you're doing an asset sale, you will select certain items as a part of the business, things like accounts receivable, et cetera, which you are purchasing. You may have equipment, other items. Just understand, what's in the balance sheet. How does that relate to the deal you're working on or you're pursuing? And then what are you actually buying in the balance sheet? So if we zoom out in the due diligence process, where are you at? If we think about if you're actively searching for a business, you're very likely in these initial discussions. If you're just starting your search, you're also here too. These initial discussions are pre-LOI discussions with brokers, sellers, reviewing, dozens of SIMs and marketing materials for prospective businesses. From there, and two of you mentioned you're under LOI, so you know this very well. Once you have these initial preliminary discussions, you move into a letter of intent. This letter of intent is typically drafted, it's a few pages. It outlines the purchase price, the terms of the transaction, the type of transaction, and then when is expected closing. It may have other terms, but that's loosely what it is. Once the letter of intent document is signed, um, it essentially binds, and your due diligence period and exclusivity period kicks off. From there, you will conduct comprehensive due diligence, financial, operational, tax, uh, customer diligence, etc., during your due diligence period, which is typically 30, 60, or 90 days. During the due diligence period, it's often best to continue conversations and communication throughout the entire process. Sellers will begin to get some fatigue during due diligence. So just keep that in mind and be thoughtful that they may be doing this for the first time. whereas you've been searching for many months and possibly years. From there, you move into the final stretch of due diligence, which is the purchase agreement phase. Typically, that is conducted, drafted by an M&A attorney. It will outline the entire terms of the agreement, and it is your legal binding document, which you will use following transaction close. It's very important that document is prepared thoughtfully, because if things do go wrong following transaction close, that essentially is your roadmap to what is entitled to you at the time of the signatures of the purchase agreement. All other items not included in the purchase agreement are likely non-binding, so just be careful that verbal promises are actually written in the purchase agreement. From there, you move into closing and assuming the transition. So some key components of financial due diligence specifically. You need to conduct a thorough assessment of the financial statements, income statements. What is the profit and loss? What are the expenses? Are there any non-recurring expenses or non-operational items that need to be pulled out? Understanding the cash needs of the business. Go back to that first example of what does the free cash flow look like of the business? Verifying the revenue, so understanding what are the sales records of the company. Does the company have any customer concentration? Conducting a thorough expense analysis. Think analyzing the cost, the core cost of goods sold of the company compared to the operating costs. And then lastly, understanding what is the tax compliance of the business. Have they been filing tax returns? Have they been filing state and local returns? Have they been paying sales tax? So these are the 4 key buckets which you need to check off when you're conducting this financial due diligence. So when we think about the timeline of due diligence, I'd like to look at this slide. This breaks it down into 30, 60, or 90 days, and the various parties' stages of it. So if you're actively searching, just started searching, feel free to take a screenshot of this and keep it handy as you do navigate. So if we look at, let's say, day 1 is when you sign that letter of intent, the LOI. It is often recommended you engage and commence financial due diligence with a third party, quality of earnings firm, etc. From there, you also should begin SBA bank and underwriting processes. The reason why I like to do these together is likely your quality of earnings team will move a little bit quicker than the SBA banking and underwriting process. They will ask a lot of the same questions of the quality of earnings team. So I find it beneficial to start these processes together, because a lot of the same documents the quality of earnings team will ask, the SBA will also ask, and you can help clarify. At about the 30-day point, it is often recommended to kick off your tax due diligence. So think understanding the tax compliance of the business. Has the business, been filing tax returns appropriately? Are there discrepancies between the tax filings of the company and the reported records? And are there any tax liabilities the company may have that you need to be aware of as the new owner of this business? In the 60-day or the back half of due diligence, it's often recommended to kick off legal due diligence, as well as starting to prepare those final closing documents. The legal due diligence team, typically an M&A law firm, will draft the purchase agreement, which coincides with that closing timeline. So if we think back to a few slides before, the purchase price agreement is the thorough document, which states all the final binding terms of the agreement during that final 30-day stretch. So if you're under LOI and you're struggling with some of the specific analysis, here's how I conduct my due diligence. So if we think about the income statement deep dive, a thorough income statement analysis reveals the true story of the company's operational performance. You want to understand revenue trends across multiple years. I like to do 3 to 5 and determine whether the business is experiencing growth, declines, customer concentration, etc. And a lot of analysis you can perform lies in the margins. So think, the net profit margin, EBITDA margin, and the gross profit margin. The gross profit margin speaks to the revenues minus the cost of goods sold. So, the direct cost to produce the revenue. The EBITDA margins is a function of operational performance, and the net profit margins is effectively all costs. So think cost of goods sold, operating expenses, rent, etc. So the overall profitability. When you're conducting due diligence, I like to do margin analysis on a month-to-month basis and look for significant swings. So if the margins month over month were about 25 or 35%, if, for example, in May of last year, it dropped down to 10%, that would be something I would circle or highlight, and I would ask questions about it. On the flip side, if margins all of a sudden spiked up from 50%, which was like the average, to 70 or 80, again, you want to double click, ask a few questions to make sure you're understanding why their margins significantly increased or decreased. The reason why it's often best practice to start with margin analysis is it can quickly identify certain items you need to ask follow-up questions about. Financial due diligence is both very quantitative and qualitative. Quantitative in that you do a deep dive on the company's financial data provided, and then you ask strategic and pointed questions to answer questions about the business that you may have concerns about. The risk of, the purpose of doing an income statement analysis is to achieve, your comfort levels because there is a risk that the company over-reports revenue and under-reports expenses. More often than not, I see companies under-reporting expenses rather than over-reporting revenues. Over-reporting revenues is very easy to spot. If you were to conduct, proof of cash or proof of revenue, you could likely see that quickly if the company tried to materially misstate their revenues. It's more challenging to uncover when they're under-reporting expenses. So keep that in mind as you think about this income statement component. So what are some of the red flags and key insights of due diligence? Beyond just finding problems, you want to be able to provide actionable insights and put together a comprehensive analysis about what is the financial position of the company, what are some positive and negative trends, and what are some strategies this business needs to continue growth going forward. So how do you achieve it? First, you want to detect and identify significant fluctuations and anomalies in the financial data. Think back to our margin analysis. This is ways you can detect certain significant fluctuations. From there, you want to analyze. So you can analyze by highlighting the items and then asking questions to understand the root causes of some of these fluctuations. Based on comments from the seller and ownership team, then you can provide, actionable strategies to address some of these challenges. Some ways to address challenges may be the business might not be actually as profitable as stated before LOI, so you might need to retrade or restructure your terms. And then really the last step is implementing. So after you've identified some red flags and insights in the business, you need to propose solutions in order to get this deal across the table. In the world of small business acquisitions, if you're in due diligence and you do see some yellow or red flags, as I like to call them, there's really just two ways to restructure deals. You can lower the purchase price, or you can restructure the terms. Restructuring the terms may be able to salvage the deal and avoid it breaking. Often I would recommend to increase the seller note. So for example, if a business was for $1 million and it was a 50% seller note, you may need to increase that to a 60% seller note. Or if it was a 25% seller note, you might need to bump it up to a 35% in order to justify the price you're paying based on some due diligence findings. A lot of these negotiations, like I just described, happen near the tail end of due diligence. So if you think about that 90-day timeline, typically in the last 45 to 90 days. So the second half of due diligence after the quality of earnings team is complete. Let's think about a customer relationship analysis. This is another piece of due diligence, which is very important. So looking under the hood of the business's revenues, you need to understand what does the customer base look like? Is there some concentration? Are there stable sales? You can do this by examining consistency of customer purchasing patterns over time. Are there long-lasting customers? So relationship strength. Have key customers been doing business with the company for 10, 15 years? Are they new customers that have just won that comprise significant revenues? All of these questions you should ask and understand fall in the customer relationship analysis. There is a risk that a few customers may represent a large material amount of total revenues. Typically, if 5 or 6 customers represent over 75% of a company, I like to deem that as a customer concentration issue. With that being said, those businesses have been able to close successfully. So it's something to think about during due diligence, and just make sure you understand it. So how do we think about the cost structure and revenue verification? I touched on this earlier, so I won't do as much of a deep dive, but in terms of cost analysis, you want to detail a breakdown of the cost components of the business. So what are the direct costs, the cost of goods sold in order to produce the revenues? What are the operating expenses, which may be, discretionary in nature or, maybe fixed? Fixed SG&A costs or operating expenses look like rent, salaries, marketing, advertising, etc. Depending on the type of business, some may have more in the cost of goods sold bucket. Others may have heavier SG&A costs. Just keep that in mind. I often see classification issues and how certain expenses are recorded in the company's QuickBooks. So just understanding on a line by line basis, what does this GL account represent and and what actual costs are being recorded to this account. A lot of this is heavy accounting analysis, which can be conducted by yourself by accessing the company's QuickBooks or by bringing someone on who's familiar with how um, typical small businesses will record expenses. Revenue verification. So revenue verification, also called a proof of cash or a cash proof, it's also called a proof of revenue, looks to prove out revenue by using the bank statements. So typically it's over a 12-month review where you take the bank statements and you record on a monthly basis the inflows, the receipts of a business, and you compare that back to how the reported revenues are in the company QuickBooks. Um, in theory, if you were to input all of operating receipts shown in the bank statement and compare that to the company reported revenues in QuickBooks, less some non-operating items, they should tie out within plus or minus 2%. This is a very detailed and comprehensive analysis, which a trained eye typically needs to do. The goal of it is to get this variance within 2% for revenues and within 5% of expenses. If there's larger variances, you likely will need to double click and understand what components are causing some of these big swings. So imagine you've conducted due diligence and you think you see a red or yellow flag in an area of concern, but you don't know if it's significant, what you should do. Here's a few red flags I will look out for. Unexplained revenue spikes. So think sudden increases in the company's revenues without clear business reasons of why they occurred. Typically, these could be one-time large revenues. Maybe the company won a new customer or a new project. Declining margins. So if we think back to our margin analysis, if margins begin to weaken, think if it was historically averaging 50%, and then in the last 12 months, margins are starting to deteriorate to about 30%, that's a sign that the company is either needing to spend more money and have more expenses to generate the same level of revenues, or the company's revenues are declining due to price competition in the market or the inability to win larger clients. The margin discussion around revenues and expenses needs to be carefully trained and identified through several discussions to understand, is the reason margins declining due to costs, maybe their vendor raised prices, or is it the customers are pushing back on price increases and actually asking for discounts? Customer concentration. So we think back to the 5 or 6 customers in our customer analysis. If one customer is comprised of over 20 or 30% of total revenue, that is something to note as you continue in due diligence. The cash versus accrual discrepancies for the non-CPAs and accountants, companies can report revenues. The proper accounting is either on an accrual basis, which is in line with GAAP, or a cash basis. In simple terms, cash basis is the company records revenues when received and it records costs when paid. Accrual has different scenarios, and it's a in line with the GAAP practices, in line with US accounting procedures. More often than not, small businesses will be reported on a cash basis. So, how do you verify the company's cash flow? You want to normalize earnings, and this is the crux of financial due diligence. Normalized earnings, in essence, is adjusting for one-time revenues and expenses and removing them from financials. I'll give you two examples. For expenses, if the company had a one-time expense for a $450,000 lawsuit, that would be something that would negatively impact the business. If you ask questions around this and it seems like this is a one-time, once in a lifetime lawsuit that they lost, it's fair to say this expense won't be incurred going forward. So this would actually increase your earnings. On the flip side, if a company had a significant project from a one-time customer for a one-time job, which they didn't expect to get this work going forward, you have to ask yourself the question, is this revenue something I can expect as a new owner? It's very challenging when you ask these types of questions during due diligence. So it's often helpful to have, a friend or a team with you to kind of talk through. A lot of times owners will speak to how these projects happen all the time, but it's really understanding the business itself. What types of customers does it attract? And is this, potentially one-time revenue something I can expect going forward? Checking seasonality is key to identifying cash flow. If the business has some seasonality in summer and winter months, it could be something you need to think about when you're negotiating working capital or cash flow. So just understand, is there seasonality with the business? This can be a simple question asked to the owner. Owner compensation, if we go back to the first slide, understanding where is the owner compensation recorded on the business, the company financial statements. Sometimes they'll show it as a single line called officer salary. Sometimes they'll list their name and then they'll say salary. It could be executive compensation. Those compensation items need to be analyzed carefully. I typically will confirm them to the payroll report, as well as tie them out to where they're recorded in the general ledger. I would caution when you're considering the owner compensation, I would push back when they try to add back the full amount of compensation, only because you as an owner will expect to get paid a salary by the company, or hopefully. Typically, I would benchmark 100,000 or 150,000 as your salary to offset against any owner compensation that's already recorded. From there, you're recalculating EBITDA based on some of these one-time expenses or revenues and add backs. So what are some, the expense reality check? What are actual expenses needed to run the business? And then what are some personal expenses? Actual expenses look like marketing, IT development of the hosting site, salaries of the employees. These are real expenses, real costs. Understand if there's any owner perks. We touched on this, so it should be very clear. If these are just clear personal expenses, you don't need to incur them going forward. Compare margins and the cost of the expenses you're seeing in the financials to industry benchmarks. A lot of times you can look up typical margin benchmarks for industries. If you're pursuing an HVAC company or a landscaping company or a health services company, there are several, probably hundreds of reports about typical business margins you can research. And then you can compare that when you're conducting your analysis. These benchmarks are all tools you can use to ensure you're verifying the financials of the company. That's the goal of diligence. Verify what you submitted a letter of intent on is real, and you can expect that going forward. So, what are some deal killing red flags? The one you need to think about is poor financial records. If you are unable to verify the financial data of the company, it's very likely you should not close on a transaction of this. The reason is because you don't understand what is the profitability of the business going forward. If you can't understand what's the profitability, you don't know if you can make the bank debt payments to support this deal. I would urge, if you're in a scenario like this, to work with someone who is comfortable in the industry and can conduct a light quality of earnings review. Um, they may be able to get more comfortable with, verifying the financial records using bank statements, detailed analysis of QuickBooks, um, management questions, etc., to get you more comfortable with verifying earnings. Declining trends of a business may be a red flag. So if the business suddenly begins to perform negatively in the last 12 months, you want to be cautious to close on a deal of this nature. Certainly, there is never a perfect time to buy a business. There will always be something going on in the economy and you yourself personally. But if a business goes from 5 million in revenues to 3 million in revenues, this needs to be considered in terms of how much you're paying for a business, uh, why this is actually occurring. Is this due to, maybe they're taking their hands off the wheel of the company because they're expecting a sale? That can be overcome potentially. Maybe there's significant changes in the industry that are actually causing this and aren't expected to go away. There's a lot of different elements when you think about why things are trending poorly. So just keep that in mind as you do conduct this analysis. A couple more buyer mistakes I wanted to call out is excessive trust with the sellers. Oftentimes during diligence, you may have valid questions about revenues declining or certain abnormalities in the business. Um, I would caution excessive trust and accepting vague explanations when you hear them from the sellers and management. I always say trust but verify during due diligence. Trust that the owners and sellers are being genuine and they have no reason to lie. But more importantly, verify what they're saying with actual financial data and thoughtful reasoning. Due diligence can take as long as it needs to. While your letter of intent may say a 90-day timeline, if you need more time to dive into the financial statements, you can typically delay closing. Um, Before you do sign that purchase agreement, you need to be absolutely certain you have thoroughly reviewed all areas of the company and verified everything. Because after it is too late, and you need to ensure you're stepping into a profitable business on day one. So, what does your due diligence team look like? Um, for those of you who, first time attending, I lead a M&A CPA firm, specifically our quality of earnings practice. I sit as the M&A advisor and financial due diligence partner for self-funded searchers, independent sponsors, and private equity folks. Um, Typically, I'm alongside an attorney and maybe an industry expert. and an SBA or other bank lender. So why conduct or pay for financial due diligence or equality of earnings? Typically, there can be an immediate purchase price savings through a higher working capital that can be delivered. Um, we may I often can lower the purchase price or restructure terms. Um, there are dozens of stories of ways due diligence has either saved from walking into a bad deal or significantly created more favorable terms for a buyer. I'd be happy to share some stories or referrals following this.